Hit it.
It's Friday, October 4th, 2024, episode 249. I'm Patrick Sresna.
And I'm Kevin Muir. This week, we welcome back to the show fan favorite Warren Pies from 314 Research. We have a terrific discussion about why the Fed cutting rates is bad for bonds and good for commodities, how to play that, and we learn Warren's favorite band. Then Patrick regales us with the different colors in talking charts.
And folks, we may even drink some beers along the way. So, Danny, hop on here. What beer are we drinking this week?
It's actually, I don't mean to interrupt, Danny, but it's one of these few times when we all have the beer. Okay, Danny, what is it? Tell us.
This is a raspberry sour. It doesn't really need much introduction because it's a raspberry sour. So. Oh.
You know, it's not as bad as I would have thought it would be.
It's juice. It's juice.
It is juice. It's not. I wouldn't call it.
It's a summertime spritz kind of.
You know how like raspberry is that kind of overwhelming fruit.
Mm-hmm.
Like just make that exponential and put it in a beer, and that's what we got.
It's literally like eating as a dessert.
Yeah.
Oh.
Yeah. All right.
Okay.
Ooh.
All
okay.
Right.
Nothing in this podcast should be viewed as investment advice. I'm still choking on the thing. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include wage whiplash woes, the crude crunch cramps, or the greenback grumbles.
Whoa.
Something I've experienced all three of them.
I was about to say I'm doing okay, but you must be having a little bit of problems there. All right. Let's get the guest on.
All right, it's our great pleasure to welcome back to the show Warren Pies, the founder of 314 Research and the portfolio manager of the new ETF, FCTE, Frank Charlie Thomas Edward. Warren, thanks for coming on.
Hey, thank you for having me, Kevin. Great to be back.
There's a lot has happened since we've spoken. I don't even know where to start. I know a lot of people kind of view you as an oil expert. Why don't we just kind of jump in there? One of the things that I've loved about you is your work with the COT, like the Commitment of Traders. And I noticed that everyone has been highlighting the fact that the short position on the oil market has been at record size. And they're all kind of thinking that we're due for a squeeze. I just would love to kind of get your feeling about oil, where we stand, how that Commitment of Traders is working into your analysis, and what you think going forward from here.
Yeah, absolutely. I think it's good to not to try and pound our chest and say, oh, we got everything right. But it does help me to start where we came from and explain what's happening and how we see it fitting together in the big picture. So we came into the year, number one, like you mentioned, the COT data, CFTC, disaggregated data has been just killer on calling crude over the last, say, 3 years post-pandemic. And that's been one of the things we've leaned on heavily because the market's been backwardated. So you get like pretty much positive physical market, positive inventory signals, and then you need to combine technicals and COT. So we came into the year and really you saw a pretty sizable short position. And our view is that would unwind and push the price of oil to about a target of $90 a barrel by the end of Q1. We thought that 90 was a soft ceiling. And we also thought that from there, the price of oil would decline steadily through the year as the fear of OPEC oil coming back to the market grew. And so that was where we were at coming into the year, and that worked out pretty well. And so, you know, as we came into this period, I'd say was known as a bear on crude oil through the middle of the year and into Q3. But like you said, you know, we had just everyone got on one side of the boat here recently. And so the COT data that you're referencing got up to the largest, the way we measure it, the largest short position for hedge funds, managed money, CTAs, whatever you want to call it, that we have seen going back really to the beginning of that data series.
Okay, why don't you explain to people, you say the way we measure it, why don't you explain to people how you measure it and maybe how that's different from other people?
Yeah, some of that I don't talk totally about.
Oh, I'm sorry. I didn't realize I was asking the secrets.
I'm happy to give a basic primer on it. But
Okay.
we don't go too deep into all of our, we've looked at it a lot of different angles. One of the things we do, just to give you a little heads up, is we do like to measure short positions as a total open interest for that same group. That's one thing we do. And then we like to adjust for the curve, because what you see is that there's a pretty strong relationship between the level of short positions you get and the curve shape. So it's more expensive to short a backwardated market, basically due to negative roll yield. So we do some adjustments in the background that I think helps give us an edge. And I've been told by clients, stop putting so much stuff on social media, you're going to lose your edge. But so I'm trying to keep some of it under my hat.
Completely understand, man.
the way we measure it, though, it was at what I would say, one way that we've shown that we can talk about here is short positioning for that group as a percentage of total contracts for that group across both Brent and WTI. That got 42%. Anything above 28%, we consider to be excessive short positioning. Our discipline tells us really you shouldn't just buy into a market with elevated short position. You can see why, because you can blow right past the 28% level and get to like into the 40s or something crazy. You want to wait for a reversal. We got a little bit of a reversal here. And bottom line is, on September 19th, we had a overweight on bonds. We had a neutral rating on commodities. We moved bonds all the way to underweight. In a corresponding move, we upgraded commodities, which we look at commodities and oil as a proxy for, because we're using the GSCI. So that was on September 19th. I'm just pulling up the chart here to see. Did you bottom ticket perfectly, buddy? No, we didn't. I wish I could. You were pretty close. You didn't miss it by much. That was out on Thursday, September 19th. That's when we publish. I think it's a trade. I think it's a pre-election trade on crude oil. I expect us to get on Brent. That's our benchmark. I thought if you got, number one, we speculated that you could get a China stimulus, which we got. And then to say that we can't always be right. What was concerning to me is we got this China stimulus against the backdrop of all these short contracts, and the price didn't move as much as you'd expect. Like from our estimate, you should have seen crude jump like $6 or $7 just on that announcement, given the amount of short positioning. It barely moved. So I was honestly a little nervous about the call. And then you get a little bailed out by this geopolitical stuff here. But I think when you zoom out, the big picture, bottom line is that when you have this kind of short positioning, good things happen, for a long position. So that's
can you just talk a little bit about your idea that you don't go and fade extreme positionings and COTs, you wait for the actual trend to change? And I think back to like the Japanese yen. The Japanese yen went, and I know you don't probably watch that as much. You're more of a crude guy and more commodity guy, but I think that was a perfect example. The commitment of traders, and all the FX data that you saw, people got short and stayed short the yen. And it wasn't really until you got the unwind that you really wanted to kind of use that as a signal. And I think that you've highlighted that. I think that's brilliant. I've seen a couple of things you posted on X of that nature. Can you just talk about how did you stumble across that? What was the process upon which you kind of figured that out? I've been messing with this COT data for years, and you just honestly, it's been a whole lot of trial and error in how to get this indicator to work for us and really find whatever, if you want to call it an edge, to find whatever edge we have. And so it's honestly testing and market observing, and the fact that these ranges are constantly shifting. Like you can't have a static understanding of what crowded is. Whatever's crowded, as the market changes and as the underlying, like I said, term structure changes, can change what is really crowded in a given commodity. And so you want to have that signal of reversal before you can actually get in and either short a market or go long a market. I think it's really important. And then the other thing is, you look at those charts and it looks so simple. I talk to clients or people on Twitter all day long who look at those and they're like, well, why don't I just follow this one chart of managed money? And it's, because it looks very good. It is a pretty good indicator the way we have it structured. But you can go through 3-4 month periods of where short positioning goes high and stays high and head fakes you and stuff. So you really need to wait for the reversal to lock it in, because you're really trying to get that short covering, or if you're shorting the market, you want to wait till everybody's in, everyone's long the market before you go in there and try and short it. And so that's just what we found has tested the best. Everything we do, we test. And so that's what we found. That is the one thing about you guys. You are a little more quantitative, or actually a lot more quantitative than a lot of folks. So you're not just kind of saying, oh, folks, look at this. This is all these shorts, buy, buy, buy. You're saying, no, we went and found this. This is when you want to buy. You want to buy when it's actually shifted and it's going the other way. All right, let's talk about this September 19th, because on that day, you upgraded crude commodities, and crude oil being one of the more important commodities, but you also downgraded bonds. What were you thinking there? What drove this kind of change in pace, and just kind of walk us through your thinking?
Yeah, so coming into mid-year, we upgraded bonds to overweight on July 5th. And the idea was that we sensed a phase shift happening in the markets, that we were going from really where inflation was the concern for really since 2022, where every sell-off in the market was marked by higher rates. So higher long-term rates, like the 10-year, let's say, would go up, bonds would sell off along with stocks. And what we thought was, now it's a growth concern. So bonds are now going to cushion your portfolio. Bonds are going to add some kind of diversification for at least a little bit. And so we upgraded bonds back then on July 5th. And as we came through September 19th, all of our economic indicators, which have weakened and softened somewhat, but they were starting to firm. A lot of the housing stuff we looked at. And we also, saw the Fed come through with their big move. And what it told us was two things. Number one, the economic data is not nearly as weak as a lot of the bond buyers suggest and what's priced into the bond market. And number two, the big takeaway for us on the Fed was not so much that they cut 50, is that the Fed has the economy's back now. There is a real strong Fed put under not just the market, but the economy too. And when you step back and look at bonds, a 10-year at 3.7, which is where it was when we downgraded bonds, is discounting, in our view, all of this cut cycle. So right. The Fed is projecting 200 basis points of cuts. I think we can walk through the reasoning, but I think that's all in that price, all 200 basis points. So you really need a recession to return any value from bonds.
All right. So let's a couple of things I want to talk about in there. I guess let's start with your idea that the 200 basis points is already in the market. And are you implying that you think that will be the trough rate on the next cycle, like the R star? And in essence, the market has run ahead to where R star is for this economy?
Ooh, that's the $64,000 question, like where is neutral? And no one knows. And I thought it was funny that Powell, he quoted the Bible. It said, we'll know it by its works, which, what does that tell you? Is that they're going to lower rates until either the labor market tightens significantly or inflation starts to heat back up. That's what it tells me. So
that's from the Bible. I didn't realize that. I missed my Sunday school. I thought you were going to say that it was that. Like that
if you read the 314 report from 9:19, we started the report with a Bible verse.
A Bible verse. So, I thought you were going to say it was like that judge who says, "I know pornography when I see it."
No, that's just straight from the book of Matthew. But anyway,
see, that's how we're different. I'm talking about pornography and you're talking about the Bible.
I wish we were different. Oh man, it's a constant struggle, Kevin.
Yeah.
No, but so where is neutral? The Fed says it's 2.9 in their dot plot, right?
Right.
Here's another way to look at it: is like the 3-year rate 2 years forward, which is something we look at there. So we can use the 2-year bond and the 5-year note. I guess a 2-year note, the 5-year note, to imply what is, after we get through this 2-year period of normalization, what's the market say about neutral? And that rate's at least it was back on 9/19, like about 3.4%. So I think it's fair to say neutral somewhere between the Fed's estimate of 2.9. I honestly think that's a little low, and 4, which is that 3-year rate 2 years in advance. And so if you say that's where neutral is, then you can start working backwards to a fair value of the 10-year. So the 10-year should be from history, about 110 to 140 basis points above a normalized Fed funds rate. So if we go, let's take the midpoint of that. Let's say we're at 3.2 for neutral rate of interest. Then that means that the fair value on the 10-year is somewhere around 4.25 to 4.5%. Right. And that's what I think. And the only way you can, so at 3.7, there's really no value. There's no meat left. There's all those cuts. So that's all those cuts. You have no room for anything to go wrong on the inflation picture. You have no room for the economy to reaccelerate. You've discounted not just the entire cut cycle, but you've discounted it plus some more. So again, in my view, you need a full recession to return value at that level in the 10-year, and we just didn't see it. We don't see a recession right here.
I think it was a great call. I think it was one of those things that a lot of people who don't follow this closely are kind of perplexed by. They'll think to themselves, "Oh, the Fed's cutting. That means you should buy bonds, like interest rates are going down." And you've highlighted kind of what more sophisticated fixed income guys know is that an easier Fed is actually often a steeper yield curve, which could mean in this case actually that the bond might increase in yield.
Yeah, and in our downgrade, one of the things we were mapping it to previous soft landings. So previous soft landings, we thought we could get the 10-year when we were long the 10-year in long overweight bonds. We thought the 10-year would get to 3.5% about within the weeks following the first Fed cut. But then you could see right away it was a 50 basis point move. I think if you had a 25 basis point move from the Fed, the market could have pushed them a little farther, and you saw that final plunge to 3.5. But the Fed really got in front of it, cut 50 basis points for better or worse. And I think that ended up causing the long bond to sell off a bit.
I completely agree. And that's something that's so counterintuitive for most people. They don't realize that the Fed being aggressive actually ended up being the reason that the long bond went down.
Yeah, no, that's once the Fed. So here's exactly the way I agree with you. And here's how we would put it is that if the Fed, so I look at the bond market priced at 3.7, which is where we were that day, as pure recession insurance in a portfolio. It's only there to protect your equity portfolio and other risk assets in the event of a recession. Without a recession, you're going to lose money, and cash is way more attractive than bonds for sure. And when the Fed underwrites the Fed put at a higher strike price, it's taking the place of that. So you don't need that recession insurance because the Fed is writing you a recession insurance policy through their aggressive action in the bond market. Says, okay, the marginal buyer of the bonds steps back and says, okay, we don't need these anymore. It's not recession. We don't need recession insurance anymore.
That's a great way of putting it, actually. I love that. All right. In one of your reports, you have this great, I guess, is it a regression analysis where you look at what the Fed is highlighting in terms of the three different unemployment core PCE and the time frame? Walk us through. There's something you kind of, I guess, empirically show that the Fed's, what their focus on has changed. And I'd love to kind of get your kind of insights into that.
Yeah, this is something that I've worked with Fernando, our data scientist, my partner, a lot to come up with this look, and we've been watching it for every quarterly SEP. We plug in the variables in.
And why don't we just tell people what SEP is?
The summary of economic projections, which is when the Fed does their dot plot 4 times a year at the end of each quarter, and so you hear a lot of discussion of a reaction function in the Fed. And I'm not an economist. I didn't, I've like no formal training in any of this stuff. And so I just talk, in my own kind of plain way or how I understand things. When I hear reaction function, it means given a set of economic inputs, what's the Fed going to do? So if you give me this kind of inflation rate and this kind of unemployment or labor market picture, what's the right Fed funds rate at some point in the future? And so that's how we look at it. And so what we've done is, from 2022 on, we've plugged in every Fed SEP into an equation. And we say, okay, given this unemployment rate and given this projection for core PCE, this distance out in the future, how many Fed rate cuts or rate hikes does that imply? And so it should be somewhat stable over the course of all those SEPs, right?
Right. Okay.
And so so what we did is we plugged those things in. So let's talk about September. In September, the Fed said we're going to have we project out to the end of 2025, unemployment rate of 4.4% and a core PCE reading of 2.2%. And so that's the third variable in our equation is actually time to the forecast. So that's like 1.25 years out to the end of 2025.
Okay.
And put those things into the mix post from 2022 on, really this regime we're in, it suggests the Fed would cut by 125 basis points. But instead, the Fed cut or projects through their dot plot 200 basis points of cuts. So it tells us that the reaction function has shifted in a dovish direction. So the Fed has gone, given the same economic inputs in what they would have done based on previous SEPs in the cycle, the Fed's cutting much more, 75 basis points more than they otherwise would have based on this dot plot. So to me, when you control for all those things, the bottom line is you can step back and distill out what is the Fed's posture. Are they getting more hawkish given the same variables, or more dovish? In the September report, in the September projections, from our view and in this framework, it's a very dovish shift.
And that is part of the reason that you went and changed from this underweight in commodities to an overweight in commodities, and you sold the long end of the bond market.
Exactly, because just like we said, if the Fed is this attuned to the economy and this committed to cutting rates and getting back to neutral or wherever that is, testing the bounds of neutral to save the economy and save the labor market, then it's less likely we get that recession. They're not trying to push the economy. They don't see the need to push the economy into recession. So again, it goes back to the bond market being only priced for a recessionary outcome. And so it's less attractive.
Okay, one of the things that you spoke about earlier is you said something to the effect of the bond market was only attractive if we got an actual recession. And I guess implied in there is the fact that given that you're kind of underweighting bonds right now, you don't think a recession is coming and that you're in kind of soft landing camp. Can you tell us why, if first of all, am I correct in my interpretation of your stance? And if so, why you have that view?
You are correct. I would say soft landing is our base case. That's not to say we aren't going to get a reacceleration of inflation at some point, but I think that if the Fed is able to cut here, like say they cut 100 or 125 basis points in 2024, and then they cut another 50, I mean, that's a soft landing. That's what the market's going to discount and everything else. We'll talk about the inflation when we get to the future. But yes, I think we're in a soft landing environment. And so what are we seeing that's leading us to that? Well, let's set inflation aside for a minute and just talk about the economy. Our framework for the economy is the housing market. I think that every major recession in modern economic history has been preceded by job losses in the residential construction job market. About
Okay.
a 8 or 10% drawdown in payrolls is the actual rule of thumb that we like to throw out there. So what we do is, and we look at all these kind of early leading industries within the job market, but we really focus on residential construction because we can model all this stuff out in the housing market. So we model all this stuff out, the amount of starts that are happening, single family starts, multifamily starts, the amount of time it takes to complete each unit. And we ultimately get to units under construction, single family units under construction, and multifamily. And then we adjust all that for the labor intensity. It takes about 3 times as many workers to build a single family unit versus a multifamily unit. We put all that together and we say, okay, given where all these inputs, how many residential construction jobs do we need in the economy? And so do we project a decline in this leading indicator, or what do we expect? And so the first big point is that we just got a jobs report today. Residential construction jobs made a new cycle high. So we're still adding jobs there. So that's a leading indicator. Remember, you don't want to anticipate a leading indicator. So we see a healthy print in that cyclical area of the economy still. The other big statistic to remember is that a recession is defined by job losses. So, and if you're going to get job losses, you're going to have these cyclical areas of the economy roll over. And so construction jobs make up 5% of total jobs in the economy. But if you go back through all the historic recessions, they make up 30% of jobs lost. So you need these construction jobs to start rolling over in order to really kickstart a recession. Otherwise, you're just never going to get those job losses. Just no way. There's no path in the math of job losses to get there. You're not going to get the government laying people off for healthcare or education, and if you're not getting construction, you're just not going to get there. And we don't see that. Now, with all that said, what made us worried at mid-year, and that I think the Fed's trying to counteract, is when we put all of our modeling together, it suggests that there is a little bit of overcapacity in this construction segment of the labor market, the residential construction segment. And so that means that we could either be set up for negative revisions or outright layoffs in that data set, which would start to trigger a recession warning for us. And so we're on the lookout. And that's why we added bonds back at mid-years, because we thought that the risk of recession had gone up. And so you want to have that protection if you see those risks rising. But in the interim, you had the Fed come out. We've already talked about that. And you also had housing starts data come out and say it's not as dire as we had some really nasty housing start prints. Could have been some storm stuff in Texas or whatnot, but we basically got a rebound in housing starts, which reassured us that the economy is not rolling over right now. The housing market's not rolling over imminently here right now. So you put all that together and it looks a lot like a soft landing. The last piece, not to go on and on, but the last piece that has to click into place though is these, and this is where I see the real risk, is these lower rates have to be stable on the long end because that's what transmits into the economy. They have to stay here, and they have to reaccelerate the housing market and the economy. So I think we're watching things like mortgage purchase applications and interest rates. We have like some little basic scatter plots that we do of that. So we want to see, as rates fall, mortgage purchase applications coming up, indicating this leading indicator of what we're watching is starting to respond to lower rates. So that's the rub on a soft landing case, is you need these rates to stay low and you need the economy to respond.
Okay, one of the things you mentioned is that this housing employment just hit a new high, and so that's good news in terms of not if you're worried about a recession. On the other hand, do you worry that this actually could cause a reacceleration that would put the Fed maybe on hold or make it so they can't hike as much? And even worse, what if inflation ends up being higher than everyone expects and the Fed is kind of stuck? Like, one of the things is you talk about the fact that you expect 125 basis points in this soft landing. Traditionally, like soft landings, I think are 25 or 50s, right? Like you don't usually get that sort of easing in the actual soft landing.
I mean, it's a great point. That's why we call the report uncharted territory, because the Fed's SEP is projecting 200 basis points of cuts, basically a stable labor market, continued real GDP growth, and falling inflation. And we've never seen that environment ever in the history of the economy. And so any 200 basis point cuts in a 15-month period, which is what they're projecting, has led to or been associated with a recession. So It's absolutely a different kind of beast, this economy that we're looking at. But I would counter and say that we've never seen a 7% deficit as a percentage of GDP during expansion. And I think there's reason to expect things to turn out maybe a little differently this time. So to get to your question though, I do worry about reacceleration. We did a lot of work on shelter inflation. We might have talked about that, you and I, our last time we visited, but our research indicates that shelter inflation is still going to remain sticky into next year. And the Fed has anticipated that falling. I think it's a really important component of their thesis, is that shelter is going to fall. Now, if the Fed's going to outright ignore it like they have been, then I guess we should ignore it as investors. But my concern is, will shelter inflation really start to disinflate like the Fed projects before goods deflation ends? Because right now, there's a barbell going on in the CPI. Goods are outright deflating, pulling down CPI, and shelter is still going strong and adding like 0.3 every month over month, every month to CPI. And so if we had a situation where shelter stays where it's at and goods just come up a little bit, you could be at like a 0.4 month over month CPI reading very easily.
So what do you think happens? What do you like if let's just imagine that occurs? What does the market like? Where is the pain? Is it in bonds? And when does the stock market care about higher long rates?
That the pain is first in the bond market.
Yeah,
for sure. I mean, like we just walked through, if you're starting at a 3.7 on the 10-year and you started getting some inflation readings like that, the bond market's going to start, questioning the whole cut cycle, which we said is already priced in. Right. If it got bad enough, I suppose the bond market could start thinking about hikes again. I think it's premature to go there. People have a tendency to jump into the book without reading the middle chapters, and that can mess you up in markets.
But Warren, wouldn't even scarier be a Fed that ignores it? Like for the long end, like a Fed that looks through it and says, oh, you know what, we're going to cut anyways. Like, isn't that really the long end's worst nightmare?
I mean, in many ways, that's what they just did. I don't want to. I don't want to be like one of those guys. I really don't. But like the CPI core CPI was, if I recall off the top of my head, printed at over 0.3% month over month, and we're still pretty elevated. I mean, I know that they're looking at core PCE and all that, but when you play it out to the end of the year, core PCE has to be at 0.15% month over month through the rest of this year in order to hit the Fed's core PCE target for the end of the year, which I think is 2.6.
Right. But at the very least, you could have said, like a few weeks ago, you could have said 1 year inflation swaps well below 2. The market's not concerned about inflation, so therefore we shouldn't be concerned about inflation. But here we go. All of a sudden, they lower 50 basis points. China stimulates. Maybe there's even geopolitical concerns or tensions that causes oil to go up. Next thing you know, inflation is kind of running hotter again, and the Fed's kind of stuck. They put themselves into this box where they're kind of almost did forward guidance. Obviously, he's kept the door open, but I worry about it, and then I worry even more that they just keep going, and then we get a situation that's just going to be wild. Like it could be like Fed lowering while the economy's smoking, and I think that's what Druckenmiller and a lot of other folks are worried about as well.
Well, number one, you got to own gold. I mean, that's the reason why gold is in a new secular bull market, because it's all those outcomes that we're trying to discount. Like all those roads lead back to gold ultimately. I mean, and like I really don't think it's useful to be like too doomerish or anything like that. And we're long, and I'm expecting a soft landing and all that stuff. But like, let's get real with ourselves. The deficit is I think the deficit is a source of inflation. Everyone can debate that till the cows come home, but that's what I think. I think the deficit.
I'm with you, buddy. You're in safe spot. You're in a safe spot right now. The trust tree. The trust tree is
holding me. I feel the embrace. It's not a safe world out there, Kevin. So it's hard to be honest. So no, I don't think you need to own gold, and I think that it's a real. So that's why I think you're going to need to get technical, though. So the bottom line is, when I zoom way out, I do think inflation's coming back. I think we're in a new secular regime where inflation's going to, bottom at 2 and then go higher, versus like the Fed labored for years to get inflation up to 2. I think we're in a new regime where they're going to work to get it down to 2. But let's just say that's big picture, and we don't know the timing. Here's the one thing I always say about inflation. Everyone one of the first projects we did at 314 was build an inflation timing model.
Okay.
And if you go through our service, what you'll notice is there is no inflation timing model. And I think we're pretty good at modeling things. You cannot model inflation. Anyone who talks confidently about inflation and the timing of it, I think is filled with hubris, to be totally honest. We can be, the Phillips curve works sometimes, it doesn't work other times. Oil bleeds into stuff sometimes it doesn't. The oil intensity changes across economies. There's a lot of moving parts, and it's hard to know. Our mental model is the deficit is going to cause that. I think we are in a new regime. You can look at the overall level of the price charts of cars and houses and all these other things, and you can feel it out there that we've shifted gears, but the timing of that is uncertain. So when you get down to the nitty gritty and what matters for the next 6 months, 12 months, which is what people who are listening to this podcast care about, I think it's going to be about getting down into the shelter inflation data and figuring out when it rolls over, and then also backing out when do goods prices start to respond in a positive way? Do they start perking up? Because that would be the oh crap moment.
No, you can say oh shit. It's okay.
I'm trying to work on my language, I have kids and stuff.
All right. One of the things that we mentioned earlier is that you are a portfolio manager for a new ETF. Let me just grab it here. It is the FCTE ETF, Frank Charlie Thomas Edward. I know you're not going to brag about it, so I'm going to brag about it for you. I believe it's beating the S&P 500. Why don't you talk to me about this strategy and what it does, and kind of give us some details?
Yeah. Well, the ETF is based off of a model that we've been running at 314. So our main core stock selection model, the full cycle trend, FCT that's where that FCT comes from. The full cycle trend stock selection model. It's a long only stock selection system. We pick from the S&P 500. basically a two-step process. We take the S&P 500, we scan it for the top 100 stocks by quality. Look, I spent like a decade in the energy world where the only big message, or one of the big messages that's gotten pounded into my brain, is quality. You can't overpay for quality. Quality matters. And so we are first scanning for quality. And then the second move is to rank by trend. And one of the things we found in our research is that as long as you can get an intermediate term uptrend in a quality stock, buying pullbacks is extremely profitable in that space. So if you're fishing in a pond that's quality, you want to buy dips consistently, especially if there's an intermediate long-term uptrend. So that's the system. We do that every month in this model. We've run it for years. It's up 50-something% in the last 3 years in real time. And we had a lot of clients come to us and say, it is rebalanced monthly and there's a decent amount of turnover. We turn that portfolio over about 4 times a year. And, clients came to us and said, hey, if you put this in an ETF, it would really save us on taxes. And we would invest. So It kind of became a grassroots thing for us to turn this model into an ETF. And it's done really well. I mean, like you can never really time your performance, but the performance has been done well. And our asset growth, we're close to 500 million in assets now, just in 3 months.
Oh, congratulations! That's awesome.
Thank you.
That's terrific.
It's been great. I mean, honestly, it's been one of those. It's touching to have clients invest their money with you and believe in you. So, and I believe I invest my own money, so I believe in it too. But that's
full cycle trend ETF. Is that correct?
Full cycle. Yes, that's correct. Yes.
Now I got it straight in my head. One of the things you mentioned is quality. Everyone has kind of a different definition of quality. What is your definition of quality?
I love quality insofar as it isn't well defined like these other factors. And so we did our own kind of testing. The base, there's a few things going on, but I'll highlight 2 that are important. Number 1 is return on invested capital. So that's pretty meat and potatoes type stuff that we look at in the fund. But the thing that's unique to us, one of the things that's unique to our definition of quality, is we look at drawdowns of earnings over a multi-year look back. And so, what you want to see, what we want to see low drawdowns on earnings. So, and we do this across multi-years, hence the name full cycle. So we want to see these stocks that have earnings power through a full cycle. Now, a lot of quantitative strategies, they'll do earnings volatility where
that's right. I was going to mention that the earning volatility is a very standard one, but yours is slightly different.
But I prefer this because you're not getting penalized for upside growth spurts. So, if your earnings grow for 50%, but you don't give that back at all on a drawdown basis, you're not penalized for that. Whereas if you so you get more of it's less of a low vol and more of a quality core, like you just on the downside. So we do things like that.
Sense.
They're a little different, and we're proud of it. It's done well.
Well, that's awesome. That is terrific. All right. What else in terms of like what you're thinking about? Like, what are clients talking about? You want to talk a little bit about China? Like, do you have a view?
Well, not too much. We're basically domestic focused. My view on China is more of I'll be honest. We have an asset allocation model, and we removed China years ago from it because
You're Stanley Druckenmiller camp.
I am more in the Stan Druck camp, to be totally honest.
That's fine. That's what makes a market.
Right. But it does not mean that the market can't rip. Obviously it ripped, and there are folks who are smart and know that market and trust the authorities there more than I do. But I guess I don't have that level of trust to put
it's a trust tree.
The trust
it doesn't extend all the way out to China. No. All right. So when you're talking to clients, what are they worried about the most? Like, and what what is the kind of on the top of their minds that you feel like they might just be missing?
Well, here's the things on the equity market we haven't talked about that I think are really important to hit. Number 1, this year's been defined by what we call a chase. Everybody came into this year expecting a weak first half, strong second half. That was the election year playbook. And this year started with what we call momentum thrust right out of the gates. Strategists only saw 1% upside coming into the year. So what I sense is happening is this really strong chase. Everyone's behind the 8 ball. an expected weakness, and then they didn't get it, so now they're chasing the market. And I think this is going to continue right up through the end of the year. So I think we're going to have a strong end of the year in the equity markets. We've sliced and diced this a million different ways, and I think that money's going to chase into the market, especially post-election. I know that's a little consensus, but I really believe that the risks, number one, which we talked about, is the backing up of interest rates and what happens to the market. I have a harder time with that risk. So we'll set that aside for a minute. The other risk that I've struggled with and the clients struggle with, and that we've done some research here that we haven't published yet, but I'm happy to talk about it, is valuation work. Valuations are clearly very stretched on the market. That's at least what I believe. So one of the things, what we did here for our chart book that came out yesterday, we just previewed this for clients, was we did a sector adjusted PE study of the market. Okay. So the idea, I don't know if I've never seen it before, but maybe it's not to say no one's ever done it, but what we did is we held constant the composition of the market at today's sector composition. And so we took comm services and considered that tech. We took Amazon out of consumer discretionary and said, that's really tech. And we threw that into tech, and we said, okay, then if everything else shrinks down and we hold those sector weightings constant and then run a PE ratio and a bunch of valuation metrics on the market, holding those sectors constant, what's the average trailing PE ratio of the market? Sector adjusted. And the answer is like over 21 times on a trailing basis. We're at like 25 right now on a trailing basis for PE, right? Right. So I'm trying to open my mind to where I could be wrong on the valuation story here. So if you look out to the end of 2026, analysts are at $303 a share. So let's say $300 of earnings per share in the market. And then that's a 30% growth rate in earnings alone. And then you say, what's the right multiple on that? On this sector adjusted basis, even if we said it goes all the way back to the historic average, despite whatever AI tailwinds and whatever things going on with the margins, then that takes us to like 6,400 at the end of 2026. It's not crazy upside, but it's like 7% annualized or something like that. And more importantly, I think it's, the game continues. And so what's the 28 estimates going to be at that point? Why would you assume multiples fall if we actually get this soft landing, all these things? So valuations are a concern. It's held me back from getting way overweight equities, even though I've been bullish. So I've been trying to work on that. And I think you have to check your premises. When you have something obvious you see in the market and you think you're smarter in the market keeps going up, I think it really pays to take a step back and say, how could I be wrong? What's another way of seeing this? So we're doing work there. I think that sector adjusted PE stuff, it was interesting to me. So
yeah, no, that's great. It's very interesting. One of the things you mentioned earlier, though, is the bond market. Isn't the real concern the term premium? Isn't that really, the risk premium, not the term premium, the risk premium for the equity risk premium? And isn't it exceptionally, isn't it at extremes?
It is low, but I think that the way you get around an equity risk premium is through growth, which is where, again, I think that we have to be open-minded to the idea that the growth that this market could generate might be much more than history suggests. Like when I think about it, what does this market have to do with like the 2006 market? When you say like, wow, look, I wish I could have bought the market at 15 or 14 times earnings back in 2006. Well, in 2006, energy was like 15% of the S&P 500. Financials were like, 20% or something like that. And tech was just like,
sliver.
Yeah. So it was a totally different market, cyclical, value stocks. And so I just think that most people who have a real hang up with valuations look at it more through like, hey, what's the historic relationship between stocks and whatnot, and so I think that the growth cures all ills, including the depressed risk premium, is how I would say it.
I like that. Growth kills. What is it again? Growth kills all ills.
Ills, maybe I should have said cures all ills.
Cures all ills. Yeah, that sounds a lot better. I've got cures all ills. I'm writing it down just in case. All right, Warren, it's great to have you here. I'm going to spring something on you. I didn't tell you. I got a new last question, and I apologize for not letting you know. It's called the Triple Bs. You got to name something you stumbled upon that you are excited about. It has to be a book, a band, or a broadcast. It could be a podcast, a TV show, anything. Just something that's interested you, that's new, that you've stumbled upon. Nobody's chosen bands in a long time. Have you got any new bands?
I don't know if it's new. It's not new to me. My go-to band for the last 10 years, 12, 13 years of my life has been The National.
Okay. Yeah.
I don't know if they're not that. Some people, I think they did something with Taylor Swift here, like last year. It's kind of sucks to bring them up as a band, but they're not new anyways. They haven't released a new album. I wish I was like had something more.
I wish you're saying, Kevin, I wish you told me.
Yeah,
Let's talk a little bit about The National, though, by the way.
If I have to say something, I watched the Vince McMahon documentary on Netflix.
Yeah.
And that was pretty interesting to me. It's a good character study. I love it, like a good character study.
Vince McMahon, the wrestler kind of guy?
Yeah, it was like a 6-part documentary. And I think
6-part
sucks. Yeah, Netflix sucks, but this was an interesting documentary. I was on vacation and got into it.
That's a real commitment. 6 parts on Vince McMahon. About The National, by the way, they were playing, and I don't know if they're touring like the entire North America with it. They actually had War on Drugs opening up with The National.
That would be great. That would be a great.
Yeah.
Oh, yeah, 2 of my favorite bands.
Okay, so name your favorite National song.
Terrible Love.
Oh, that's like a deeper cut. I don't know that one.
No, it's from their it's the same album with like Blood Buzz Ohio.
Oh, it's like a recent thing.
No, it's from 2010. So when my kids were growing up, I would sing a song to them going to bed at night. Blood Buzz Ohio from the National.
Yeah,
so
I know that tune. Yeah,
that's another one in there. So it's there. That album was just a killer album, and I think it came out in 2010. So it's been out for a bit.
I love I Need My Girl. And then I like the fact that they did this New Order t-shirt because I'm a big New Order fan. And you wouldn't think that the National would be a New Order fan either. Don't you think it's kind of a little bit?
Order. If you like New Order, you probably like National. There's some thread there. I don't know what it is. There's some synapse.
All right. So tell people where they can find more about 314. It is mostly an institutional product, I believe, but I guess you will have RIAs and kind of, more well-heeled individuals subscribing. Is that correct?
Yeah, that's correct. We cater to everything from hedge funds, family offices, RIAs, and high net worth individuals. And obviously we have some investment options out there, as you mentioned, for folks now. And so, if you're interested in learning more, you can reach out to us on our website, or you can reach out to me on Twitter. Our website is the number 314 FOURTEEN research.com. And yeah, we're open for business, and it's mainly institutional, and it's not retail, that's for sure. But if you're sophisticated and you like a kind of nuanced take on the markets, we can help you.
And I'm going to give the final plug to your new ETF. If you're looking for something quality with trend, go check out Warren Pye's new FCTE ETF. Warren, it's always a pleasure having you on. Thanks a million for your time.
Thank you for having me. Really appreciate it, and appreciate the support you've given us over the years, Kevin.
All right, Patrick, it's time for Talking Charts, and it's been a while, eh, bud?
It's been a while, and let's dive into it because there's so many things to cover. First off, let's just talk about the top 3 things to watch next week. And I was so tempted, Kevin, to put the dollars number 1.
Of course you are.
But I know we were going to talk about it, so I didn't include it in top 3. But I want you to know it would have made the top 3 for me.
Really? Why do you think it's so important?
Okay, we'll talk about the chart.
Okay, fair enough. Let's do the top 3.
All right, but number 3, did we see a bottom in oil? And this is important because the chart was so bearish. And everyone was so caught up in the massive spare capacity that was around the world, and every hedge fund was short to the maximum. You had a huge amount of managed money that actually was at a decade high in terms of short interest, and everything was setting up for a potential short squeeze. And sometimes a trigger doesn't happen, but Iran and the Middle East happened, and it created a squeeze. Now the question is, does this create a feedback loop that is completely liquidity driven? You don't even have to make a fundamental argument. When enough people are offside on a trade like this, and an event triggers something like this, it becomes just a race for liquidity, like who can get out of the trade fastest. And the question is that does that solidify the low for the year for oil? And I think it has.
Oh, you do. You're in that
Yeah,
camp.
I'm in that camp. Now I get it.
I'm not gonna disagree, but the one thing is, don't you think it should have been up more given the problems in the Mideast?
Yes.
Yeah.
But I think that it's still early. I think it's still early in terms of that. And what's funny is because at the start of the week, I was like, God, the show can't come fast enough. I
You
was like,
just missed me. That's all. That's why you wanted the show
no,
to come.
that for sure. But what I was so sure that I was like, listen, you know what? There's the oil, the commodity markets. It's like there's a real good chance that this is going to turn. And literally in the last 2 days before the show, this thing goes ripping, and it's like, fuck. It's like I can't go in that. And anyway,
You bullish now.
oh, you know what?
Well, no, that's not true. You can still be bullish. I'm just saying that it would have been nice if you could do it before.
Exactly.
But the thing is, if you do it before and then the thing still looks like shit, everyone thinks you're a fool, and then everyone forgets that you actually were bullish. It's the way. It's the burden we bear.
Yes. We just come on the show to make
All right.
fools of ourselves out continuously.
What's number two?
Earnings season. And I thought there were two really important things to watch going into October.
Yeah.
And one was how this jobs number came in, but there was every indication that it was going to come in line, not beat. But I didn't think that this had a high probability of being a miss, especially that you have to think at minimum that there could be some political massaging to not interfere with the election. But whether it's true or not doesn't matter. The thing is, I didn't think it was going to be a miss. I didn't give it a high probability of a miss.
You're calling this a miss? You mean like a beat on the upside?
Well, it beat, but I would say I
you're
wasn't
calling that a miss.
No.
You're saying you were saying that there was no way that it was going to be low.
Yeah, I didn't think it was going to be a miss number, and so, but if it was, it would have been a pretty freaking big deal. And the fact that it was a beat now, it certainly puts a dynamic in the bond markets, which I want to talk about. But listen,
okay,
let's talk about the second one, which was earnings. And the one thing that always accompanies inevitably a bear market, if one was to arise. So let's just go through a scenario, because a lot of people remain in the no landing, soft landing camp. But if you are in the camp that there is still going to be some sort of economic consequence to the high rates that we had over the last 3 years, and some economic recession was coming, one of the things that causes bear markets is when corporate earnings ultimately contract. There's sometimes periods of 20, 30, 40% earnings contraction, and so far earnings have been completely not only in line, but almost everyone has a forecasted earnings growth going into next year. And therefore, I think it's such an important thing to watch going into earnings as to whether these companies can keep that expectation up there, or will the guidance ultimately suggest that they're going to start having their earnings and balance sheets and all impacted. And so one way or another, I think that's why I think the earnings season in the next couple of weeks is important. Now, when we're doing this, but we will be doing another market huddle session before the big ones report, right? So there'll be another conversation we'll have, but we'll definitely get those early things, particularly the financials and others that are going to be coming out here. It'll be interesting to see what they say. You have any thoughts?
Well, I think it'll also be interesting to see if we get a broadening out of the earnings, like the good earnings, because up until now, or especially over the kind of previous 9 months, a lot of it was the good earnings growth was concentrated in the Mag 7. And in terms of the market, it's broadened out. And the question is, will the earnings broaden out? Was the market just ahead of the earnings? And we're going to see better numbers out of things like banks, as you mentioned, or home builders and things like that. And whether that will actually play out in terms of the numbers.
Yep. That's a lot to see. And so number one, the inflation numbers next week. And so obviously this is more your camp. What's your thoughts here?
Well, one of the things we were chatting about this before when we were setting the order, the preference of these top 3 things to watch next week. And I pushed back on the earnings being number one because I think inflation is going to end up being the number one. We just had a massive beat in terms of unemployment. We had 250,000 jobs. Everyone's expecting 150. And in fact, there's lots of whispers going around that September is often a weak number. And so if we get a situation, Patrick, where we get inflation surprising to the upside as well, what does that do to the Fed? Like the Fed has
That's a
done up.
policy error.
Yeah.
It's a outright policy error. But the interesting part for me, obviously, you're suggesting that the strong employment number could be a driver. But I've always been in my mind a believer that one of the most important precipitating drivers in inflation is rising commodity prices. And suddenly, this China stimulus has turned all commodity prices. Now, that probably won't translate into a hot inflation number this month, but if we see that the commodity markets have turned the corner and we see all the commodity markets rising, you have to think that we're going to see it somewhere translate into PPI, and we're going to start seeing at some point some of these inflation numbers uptick, and that could cause some alarms to be rung.
Yeah. One of the things, Patrick, I watch really closely is the 1-year inflation swap. So what this
Yeah.
is what the market is expecting inflation to be over the next year. When we did this kind of almost a month ago, the 1-year inflation swap had fallen well below 2%. We were trading even down to 165 at points
Yeah.
when the market was looking a little sketchy and a little like when oil was really ugly and it was looking terrible. We've risen to 2.23. It's a big increase. And it'll be interesting to see if, I too think that probably inflation this time won't show up. This is like September number, this isn't the September number, right? This is, oh no, maybe it is the September number. But regardless, it's a rearward, like it looks like, let's try this again. We're looking in the rear mirror.
View mirror.
Yeah. And so when we're talking about this, I kind of think that one of the problems is that as the Fed has eased and as things have gotten better, the market is running ahead. So in terms of this inflation number, it's not going to matter if it ends up being in line. It won't be the end of the world. But if we do get a situation where this actually ends up surprising to the upside, we're going to have a double whammy badness. We're going to have unemployment, the employment market getting much tighter. We're going to have China stimulus causing a lot of things to rip. And then all of a sudden, we're going to have a Fed that's misjudged the inflation market.
Yeah.
I'm worried about this, Patrick. I think that we're setting up for a big policy error in terms of the Fed, and the narrative can shift on a dime. Like we're sitting here when, it was just a couple of weeks ago, everyone was screaming that the Fed was behind the curve and had to do 50s, and we were going to get a series of 50s. Now, all of a sudden, it's looking like that the next 25 might be in jeopardy.
All right.
I know it's not. I know the market isn't pricing that. But if we were to get a big inflation number, that's not off the table.
All right. Well, let's start off. Let's look at the charts here. I want to start off by just looking at the 10-year bond, and I think there's this one tourist that called the top on this pretty accurately. I don't know if you know him, but yeah. But what date did you call that? Write that piece?
Oh, I don't know. It doesn't matter.
It was around the Fed meeting, right? But anyway, the point is that the long bonds have more or less been pulling back, and this jobs numbers was just a kick in the pants in terms of a breakdown in these, right? And one of the things I was, by the way, I did flatten all of my long bond trades into the Fed because I was of the opinion that it was going to be the buy rumor sell news kind of reaction to the FOMC. And so, but the thing is that I was telling a lot of my members that we would be on a retracement like this, potentially entering back in. But I think at this moment, I just want to wait a little bit because this is there's a lot of things that are about to be revealed that could make this pull back a little bit deeper. But the one thing that was a big theme for me, and I think you can appreciate it because I think you're in line with that, was that the market simply was pricing in way too many rate cuts. That they were way too dovish. I mean, we went from in May, it was they were pricing This is, by the way, the Z 2025 SOFRs, right? And so they were pricing in by the end of next year rates at 4.5% back in May, and we went like all the way to like 275.
Yeah. Crazy.
They were basically more than 3% rate cuts, right? Well, not in this case, 2% move, but 8 rate cuts got priced in very, very quickly. And we've just pulled out in a month 2 rate cuts, and it's on its way to pulling out a third rate cut.
Yeah, and that's today's a big ugly red candle. Even I,
Yeah.
I'm not very good at the voodoo magic of charts, but even I can see that red candle going through the, what is that, the 50-day moving average?
Yeah.
It doesn't look good.
And so even a 50% retracement of such a move will bring it down to 96 and a quarter to 96.50. And so the idea that they pull another rate cut out and we go from them pricing in 2% or 200 basis points to only 100 basis points would be realistic. But the question then becomes, with them already having done 50 basis points, like what's the next move for the Fed if the market suddenly goes to only pricing in 4 rate cuts or 5 rate cuts? Like, do they slow down, or do they even not move next month? Like, they've already priced in.
I think that they could very well if we get a hot CPI, and I don't think that's what's going to happen. I still contend, and this is where I stood earlier, even before the 50. I thought the Fed was going to just put us on autopilot of 25 every single time.
Yeah.
Obviously, I was wrong in terms of the 50. I think they front loaded it. In hindsight, I think they viewed the pass in July or something. They had an opportunity earlier to do one, and I think they didn't, and they passed it. And I think they viewed that as a mistake, and therefore they were viewing this as catch up. And absent anything else, Patrick, I think they're going to be on 25 beeps a meeting cut until they view it as sufficiently, neutral. Because I think right now they still would believe that they're tight. And don't forget, the next meeting is after the election. So this is kind of, there's a lot of moving parts here. There's a million things. But I think that the Fed will either be on 25 beeps a meeting, or if we remember back when they were raising rates, they went like 75, and then they went to 50s, and then they went to 25. And there was a period where they were actually doing what I called 12 and a halves. And they were doing a raise every second meeting. So I could see also them putting themselves on a path where they're like going to do 12 and a halves again, meaning every second meeting they're going to cut.
Yeah.
Anyways, that's my feeling.
It's possible, but they overshot. It was like literally to the Fed, on the Fed meeting, it was virtually buy rumors, sell news. It literally marked the reversal point of this. And ever since then, we've been seeing a pullback. And I think that's important because it is particularly important to the asset from which I wanted to put in the top 3, and that's the dollar.
Okay. So explain to me why you think it's so important right now.
Well, I mean, look at that reversal, first of all, technically.
Right.
Okay. Right. So like, this is a very clean reversal, and that reversal is more or less, well, look, when everyone was thinking that the US rates were going and the rate cuts were going to be so severe, that influenced dollar flows. And when everyone's realizing that interest rates are likely to stay at a higher elevated level in the United States, that shifts flows. And you can see that, like, number one, the euro made a very clear breakdown. It broke to a lower low after a double top. It broke the 50-day just the other day. And all the ascending trend lines, whichever crayons you want to freaking draw, it's the lines are broken. And then you take a look at the US dollar yen. I thought that drop and pop that happened here on this red candle, right, that I'm drawing right over here, I think is technically very significant. When you have a tap to a 50-day moving average and it reverses like that, that usually is an advertisement for a continuation pattern. And that's a point where if the market was still sufficiently bearish on the dollar, that should have shot this down to like 138, 136 on the downside. And instead, it immediately gets bought on dip. and this thing goes ripping the other way. When you see that kind of price action, it means that the exhaustion of this leg of the US dollar yen decline is pretty much over. Now, that doesn't mean that long-term forecasts of the yen going to like 135 or 130 won't come to fruition over a 1 year time frame. But on the short term, probably even for the remainder of this year, the low is in.
Okay. I'm not going to disagree with your dollar analysis. I guess where I disagree is why is that so important? Because I don't feel like the dollar is setting the tone for assets right now. And so I think you could have the dollar rallying and it doesn't really affect other instruments.
That has certainly been the case for the last week. This dollar rip has not had the natural
Right.
knock-on effects that you would typically see.
And that was my point. That was my point. You're just saying it's a matter of time.
But I think it's there. You can't discount the idea that it's a lag effect when everyone realizes that something bigger is happening. That suddenly everyone's like, okay, we have to now model this and anticipate that maybe this trend has shifted. Now, this has been already too strong of a move on the short term to go put on a brand new dollar trade long, because we're just approaching a 50% retracement zone around this 103 area. And so a lot of these moves are very mature, but I think we can't ignore this because the dollar came right down to the bottom end of its multi-year trend range. And it'll be really interesting to see whether or not it just continues to play a ping pong match in the support resistance zones. And we have a date with the top end of this range. And in the bigger picture, Kevin, that's quite insignificant. Like when you look at when the US dollar really moves on a larger scale, when you realize what kind of currency stability we had in the last 2 years. Like literally, we have not seen the type of currency volatility. Okay, US dollar yen was serious volatility. I was beyond the one currency pair,
right?
The dollar against the euro dollar versus the US dollar euro pair was a rather range bound, and it drove a far more sideways market than we typically see. And the bigger question is, are we just going to see more of the same for the rest of the year? And at this moment, on balance of probabilities, I think we're going to be bored as shit looking at the dollar in this trade range. I don't see a reason why this year it will break either higher out of this trade range nor lower. I think that we're going to be in this meat grinder for the rest of the year.
I don't doubt that you're correct there, and that I have no pushback except to say that's why I didn't want it in the top 3. I don't think it's driving other assets. I don't think it's that important to watch.
Right.
It's kind of a nothing burger to me. And yeah, I think we're going to get a rally that you can sell. That's how I view it. And,
all right, let's go.
Okay, go on. Sorry. Next, no problem. Go to the next one.
Let's just talk equities.
Okay.
And so here the S&P obviously got that burst higher after the rate cut. Everyone got the dovish Fed that they wanted, and it burst the market higher. But now the question is if the market was driven higher by such a dovish Fed, now that the market is pulling that dovishness right out of expectations, does that have the reciprocal effect on equities? If equities got the burst because of lower rates, well, now if it's not going to be so much, do the equities react the other way? That's just I don't have an answer for that. Do you have an opinion?
It's like theoretically you're correct, but I think that if it was as simple as just figuring out what the Fed does and looking at like the 2-year, then all we would do is focus on that. There's a lot more going on. The real question is, back to your comment about the earnings, is the economy broadening out? Are we seeing earnings growth and stuff other than the Mag 7? And Patrick, one of the things is you're looking at this chart of the S&P 500. Pull up the Mag 7 index or the New York FANG. I don't know what you can do. It's
I have the FANG index.
Yeah, like it's not on the highs. S&P's hitting new highs. The leadership has changed. The market has broadened. It's looking a lot better. And I think that really the question ends up being, is the economy are we finally through this kind of belief or worry that there's going to be the economy is going to be really weak, and therefore all you had to do is buy Mag 7 because nothing else would work. A lot of other things are working, and that's what I think is occurring right now.
So my speculation has been, and what my market call has been, that we're actually in the process of one of those prolonged topping formations. So whether you go back to 2000 or 2007, markets go through like these 6 month to 1 year ranges. They literally just stop going up, but they don't start going down yet. And after that huge burst higher in the markets, that was in the first quarter of the year, uh, I started to kind of make the call that we were going to, at least in the summer, that this is going to be where the top end of the range of the market is. Now, the S&P did break to a higher high, but we haven't seen a higher high in the Nasdaq. We have not seen a higher high in the Russell. We have not seen a higher high in the other global developed markets. Like we haven't seen it in the Nikkei. We haven't seen it in the Euro stock. The point being is the S&P is the only index that has actually broken to a higher high.
But I think it's important that it broke to the higher high because the equal weight went. Changed the
Yes.
whole nature.
Yeah,
Like the whole thing
equal weight-
changed.
You're the breath widened. You're bang on. That was definitely.
And everyone thought that there's no way. Everyone was like, "Oh, it's a narrow rally. It's a narrow rally. It's never going to go up." And once these stocks correct, there's no way other stocks are going to take the leadership. So far, that's not correct. Like we're getting a widening of the market, and the whole stock market is trading better. Now, whether you believe that's going to continue, and is another matter, but that is happening.
The interesting part is one thing that when markets are usually up at these kind of elevated levels, one of the natural byproducts is that usually you could buy hedges for relatively cheap. Normally, volatility would be sticky down in the low teens, and because of the elections, I would argue, we're in seasonality. We're in a situation where the markets are at these elevated levels, but we're sticking to 1920 VIX.
Yep.
And right now, even though put call ratios are actually still quite skewed to the call side, the volatility premium is being commanded. You can't buy this insurance cheap. And I find that particularly interesting is that that volatility premium is still sticky up here. I mean, do you think that we have that kind of volatility risk or going into the elections? Do you think that these markets can swing that way?
So I'm always of the belief that everyone thinks that higher stock market equals lower volatility. I find that frustrating. And although I do understand the reasons that often that is correct, I point to the people to 1998, 1999, where you got a situation where as the market ripped higher in the final throes of that kind of bull market, actually volatility was higher. Realized volatility was much higher. So it doesn't necessarily mean that just because the VIX is going up, that it's telling some sort of signal. It could be that it's just that makes sense, and that is what the actual volatility of the index is going to be over the next little while.
I'll tell you what. I'm gonna drink your sour raspberry sour Kool-Aid that you're spitting out of your mouth right there only after we get past the elections.
Well, I'm not trying to say, okay, I'm not trying to say, but
if after the elections, if it becomes a nothing burger and vol drops back down under 15, then I don't think there's a point of making an argument. I right now, I feel that the volatility premium is very much election driven. And
okay, but Patrick, can I interrupt for a second? Because
99 is
if that was the case, then the curve would look different. The VIX curve would look different, and it doesn't. It's basically flat at 20.
It's flat at 20, going all the way out to the January,
June 25. 19.91.
Okay, but contango always exists in the VIX curve. The question is that does the front of the curve come back down afterwards?
Okay, so do I think that November volatility can go back to 15? For sure. I'm not going to disagree with that. That's like
All
a
right.
different time frame.
All right, let's
What
not
I'm
argue
saying
about
though,
that.
no, but what I'm saying is that you could have a situation where the market is increasingly realizing that even if we have a continuation of the bull market, VIX should be higher than it was. It like 10 is kind of ridiculous, or 12, or wherever we were. We could have a situation where the market just keeps rallying and VIX is actually high because people keep
Yeah.
paying up for it.
Okay.
Right?
Yeah.
Like, I don't know. Like, I just think anytime people say that this number makes no sense, markets change, the behavior changes. There's all sorts of different parts of it. And I think that we could have a situation, go back, look at 1998, look at 1999. Those 2 years, we had rip roaring rallies. Realized vol was actually really, really high.
So I have one market call.
Okay, let's hear it.
The market call on the S&P is very simple. The jobs numbers here came in a positive enough way where the market's first reaction is higher, but the rates market took it on the chin, which kind of adds a headwind to the rally. If the market hasn't broken to a fresh new high, punching 5,900 by the inflation numbers next week,
Okay.
then we're going to go into correction mode. The market needs to make higher highs and follow through. And if this gets heavy here and we're not breaking out, and this thing can't make any progress, then I'll start shorting it.
Okay. I don't disagree. Probably
Okay.
means it's going to rip higher, folks.
Well, no, but if it rips higher, the market calls it. The point is that the bulls have to follow through on today's breakout. Today was a jobs number beat. The market went higher on this, and that should spark a feedback loop of accumulation that should break the market to higher highs and have it ripping follow through. And if the bulls can't follow through on this kind of positive news, then that means someone is selling into the news, and that's and we're getting to a top. So it's not right now. We're going to give the bulls the benefit of the doubt, but they need to rip it to 52-week highs. Like they need to take out that high, and they need to do it soon, like as in the next few days. And that's why I'm using the inflation number in the middle of next week, because if we haven't freaking broken to a fresh new high into the inflation number, ain't gonna fucking do it. That's
okay.
That's
You heard it.
All right. So let's talk gold. Okay. Now gold hit 2,700. That was my target. I am so bullish gold in the big picture, but this is an exhausted move. This is an exhausted move, and gold does these consolidations on an ongoing basis. And the last two consolidations were sideways. They were like this, and they lasted a couple months, and gold just took a break, consolidated to the 50 days, and then resumed its trend. And while I'm not calling for a big breakdown, I just don't see I just think that before we see 3,000 on the upside, that we're going to have a break, and it could at least take a month or more for it to consolidate. I put on some short-term hedges to kind of
like the lady on Interactive Brokers that was at the restaurant. You had to do some hedging trades.
Yes. Excuse me. I got to do some hedging trades. All right. Anyway, are you just stupid bullish?
Stupid, yes. Bullish. Yeah, I guess I am both. I think the problem
But you're
is
not stupid bullish. You're stupid and bullish.
And bullish. Stupid and bullish. Very, very fine distinction. This is what I think about gold. Today, for example, dollar ripping higher.
That should have been killed.
Like, so rates, backing up, meaning like bonds selling off, rates, the yields going higher. There was every excuse in the world for them to crush gold today, absolutely crush it. They did not. The question that I think you have to ask yourself now is, we have some Mideast tension. There's all sorts of angst out there. How much of this latest rally is kind of geopolitical risk? And I don't know. I'm not sure. It feels like today, for example, is geopolitical. Like today's outperformance versus where those things should be. Like I'm the first one that I've been recently saying that there's a situation where you shouldn't look at rates. You shouldn't look at dollar, because the gold's going on a different factor. It's actually getting driven by central banks as opposed to the financial moves in the West. Having said that, usually they would still take this opportunity to destroy gold on the dollar rally and the rates back heading higher in yield. They didn't. And I'm just kind of torn, Patrick, because it feels to me like this is just like a terrific bull market. And is this going to be another one of those cases where people are going to get overly cute about it and then the thing's just going to rip? So although I do understand your argument and I'm not disagreeing, I am concerned that it's almost too obvious.
The interesting part is that these inflection points are really important. So 2700 is a measured move. It's the symmetrical extension of the prior rise. And so typically when markets move in symmetry, this is where the market would pause and consolidate. And what usually dictates the beginning of a bubble phase of a security is when it reaches the completion of that kind of a move and then blows through it and suddenly it creates that feedback mechanism, that's thing. So we're at this inflection point where this is the typical place where in the past a correction would have begun. And if your scenario starts to materialize, it would mean that a sustained price action above 2,700 would start to feed on itself, and then you'd have to just flip outright bullish, and then you'd have to ride the momentum, because at that stage it means this thing has gone full bubble, and the thing could go to 3,000 in a week.
Well,
right? Like
no, it's
that.
going to do even more than that because I got 1,000. It's going to be up $1,000 in a week. Remember my prediction. So
Oh my
maybe
God.
that would be it. So
I
I'm
would
still
love
sticking with that.
I would love every minute of that. Let's see whether or not
Is that Bon Jovi? Loving every minute of it.
yeah.
Is
No
it?
idea.
I got it right. No.
All right, let's talk crude oil.
Okay.
On the way down, it went and retested all these major lows. Now, the amount of people, even oil experts out there, that were anticipating $40 crude oil, or like I heard so much shit on X, $40 crude, all this shit. It's like, I get it. If this thing broke a major support line and began a move, well, at least it would hit 60 or something like this on the downside. But you know what? I was in the camp predominantly that this was going to go for a double bottom retest. In fact, I gave better odds than not that we were going to have the turtle head formation where it was going to break slightly below to a lower low just to knock off all the stop losses sitting below the previous lows on there. But it didn't make it that far because of the geopolitical trigger that came in there. But now this thing has really reversed. And while you're saying you would have thought it would have reversed more on that kind of tension, it did in 4 days move $9 and 13%. I mean, sure, I guess it could have moved 20, but I think at this moment the short squeeze is on. Like we were saying, hedge funds were as short as they were in a year. The managed money was at a decade high of short interest. Every CTA that was trend following was short, and everyone that was any expert that is doing fundamental analysis based on spare capacity and all this other stuff which is important. I don't want to say that the fundamental information isn't important, but it was driving everyone to be in the crowded same trade, which was that oil's going lower. And the market gods do what they do best, and they squeeze the shit out of everyone that's in the crowded trade. And it just so happened that the geopolitical trigger gave the catalyst, the spark, to begin what I think is a very clean short squeeze that is far from over. I'm not going to be shocked if, just driven by liquidity short covering, we see $80 to $84 oil in the next week or two. And it has nothing to do with fundamentals. I just think that everyone that's going to be forced to get out of this trade this thing is just going to squeeze all the way up.
You could be right, buddy. I don't know. I'm worried that the geopolitics is causing short-term movements, and I'd love to just see this geopolitics kind of peter out and we get to see what happens.
You know what's my fear?
What?
Is that if you wait too long, it's gonna be sort of like when I was saying I'm gonna wait for a bit of a pullback to get into China. Like in the end, it's like, oh, come on, it'll retrace. It'll give me a little bit of a 50%
The best
retracement story.
markets never let you in.
Never
That's what
let
you
you in.
have to remember. The
And
best markets.
this is why, the question is that will we see some sort of a short squeeze that isn't going to give you time to
You
think?
could be
Like,
right. Listen, I'm not going to disagree with you. I just think though that the geopolitics is really driving that one. That really is, Patrick. And so
I think shorts being on the wrong side of trade is driving that one. I think that the pain trade is going to be what prevails, because I don't see any reason why oil couldn't go from hit 80 and then go all the way back to 65 by December and Christmas. Like, I think it's a liquidity event, has nothing to do with fundamentals, and I think that the short squeeze here has been triggered, and I think it's going to squeeze.
yeah,
It,
listen, that's not a bad call. I hear you. Just
right?
like China. I get it.
Like this is unbelievable. By the way, let's just talk China since I had this up. Like, what the fuck? Like, I didn't know. Like, I get it. All right, the Nikkei had a 20% crash on its thing, but this is a crash to the upside, not to the downside. Like,
Yep,
like
you're
the
right there.
Nikkei dropped 25%, but that was the typical downwards
Yeah, yeah.
motion. I don't think I've ever seen the second largest global economy in the world, have its indice freaking move like 40% in like 2 weeks.
It's
Like,
China,
what the
man.
fuck?
But listen, it's down a long way over the
It
last
is.
couple
It
of
is.
years.
But
Like, you
come
know,
on.
like so everyone's looking at this chart and freaking out. Back up, put it like from 2020 till today.
Yeah. That was that
Like
weekly
you're
chart I just
still
said.
like, you know, you're still offside.
I get it, but it's just
No, I
nuts that
get it. I understand, but that just shows you that policy can really make a difference.
all right. So
How about
let's
Tepper though, by the way? Just coming out, I'm long, I'm buying more. That guy's the beans, man. Like that guy is the beans. He's awesome. I've always loved Tepper. He's awesome. People,
what was his call? He's buying China?
yeah. He's just like, I'm buying it, I'm buying everything. People forget that back, I think it was when was it? 2010 or 2011. There was this situation when we were coming out of
I think it
we're
was as
trying,
early as 2009 when Tepper was going long.
was it? But he made
Oh,
that
it was.
argument. I remember he came on CNBC and he said this argument. He says, okay, so if the economy gets better, I'm going to be long stocks and they're going to do better from that. If the economy gets worse, they're going to do more QE. And he says, and at which point I should be long stocks. He came out and I still remember that time. He sat there. It was the same deal. He was in a chair and he said, you should buy stocks. And at
It was
the time,
2009, I'm pretty sure.
okay,
I remember seeing that.
it could be right, but everyone was bearish.
He was one of the only ones that truly freaking called the bottom. Like
100%. And he was
he's the one
willing to,
that,
but no, but Patrick, it wasn't the bottom. Like that was like, it was when we'd already rallied. And it was this point where people were losing faith in the rally and people were
right.
getting nervous about it. And they were thinking it's going to be crap. I'm pretty sure that's when it was. And he came out and he said this. And at the time, all the wise guys were all short. They were all, you seem so much smarter getting up there saying, oh, the market's going to, correct. We're going to go lower. Everyone
I would
was,
never do that. I would never.
Oh yeah, never. But he was very clear. He just came out and he said that, and it changed the whole psychology. And it was just an unbelievable call. This feels like the same to me. It really does. It feels the same. I don't know. Like it's pretty violent. I'm not trying to say
you know what? I'm
going
going to use what you just said in oil. I'm going to say here, I'm still in the Russell Napier camp. Like, you know what? You can try to, as long as you're in this trade on a very short-term basis and you're riding momentum. But I believe that there's something at a geopolitical level in the fragmenting of the world that that everything from what's happening in the Middle East to what's happening with Russia inevitably is going to drag China into it. And there's geopolitical risk. I don't want to say this is going to go RSX, but all I'm saying is that it's not as easy being a Western world investor going and putting money into China and thinking you can call the valuations and your forecasts on the market the same way without having to discount some sort of geopolitical event risk. And to me, I have a hard time publishing to my members an idea of telling them to go long China and then be the look like an idiot with egg all over my face when some stupid little event happens. Like I remember a number of prominent people that were long the RSX and then look like complete fucking idiots for having told a whole bunch of people to be in the trade. And I'm not worth. It's not worth it to me to take that risk. I'm not doing it. I'm not.
I hear you. Listen, Stanley Druckenmiller says that as long as Xi's there, he's not touching it. Lots of people have that attitude. I think the only thing I will say is that's
unless you do a gamma.
That's
you could do
that's the reason it was so cheap.
Yeah.
And you say, well, who's going to buy it? And I always kind of love these comments. I say all that we need is people just to get back to benchmark, because the reality is everyone was underweight because of that exact risk. Now all of a sudden, then that was fine when you were underweight when it was going down. Now all of a sudden you're underweight and this thing's ripping in your face. It's tough.
I
And
think
so
here the
yeah, I'm
only
not-
way to only way to do it is to go Jim Leitner on it and just get yourself some spreads up above. And listen, if it gets zeroed, it gets zeroed. But and you can make some money if it keeps ripping. But you're not taking delta one downside risk if some event happens, right? Like you go and put on a trade with a definable risk that you're accepting as a reasonable way to have participation. That's the way I think is the compromise to doing
yeah,
it.
the trouble is now Vol's exploded.
Well,
And like the reality is you should probably just go trade something else at this point.
But yeah. And it's already like after this kind of a move, that mean reversion will kick in at some point. It's just when does it start? It's like it might
After
first
it's
go to
doubled.
17,000. Yeah, it might go to 17, 18,000 before it starts to revert, right? Like leave it alone is my opinion. But let's talk about the byproduct of it, which was it really woke up the freaking commodity markets. And like obviously oil and gold have their own little narrative, but I want to just start by looking at the Bloomberg Commodity Index. Like this is the DJP, which is the ETF for the Bloomberg Commodity. We could look at the futures as well, but point is, since 2022, we've been in a consolidation pullback. Commodities have been dead. Right? Like this thing has been more or less 25% off its highs, trading in two-year downwards trajectory. Did we see the resumption in the secular bull market of commodities driven by this spark? And that is a puzzle to solve. I am obviously I'm a big fan of the secular bull market in commodities, and therefore I want this to come true. But I'm trying to get my biases aside and try to really evaluate whether this is happening. But one way or another, it's been a very strong rip. You're getting all the technical signals that the commodity index has turned higher, and you're seeing in everything from copper to the ags to uranium turning up to iron ore prices turning up. Like everything has suddenly turned higher. Are you bullish?
Oh, well, I'm with you. I'm a secular bull in commodities. Do I think that this China is as important as everyone's making it out to be for commodities? No. I think that one of the things that people have missed is that China is no longer the driver in many of these commodities.
Okay, I'll agree with that on the surface, but bull markets sometimes just need a spark.
Yeah,
From it just
agreeing with you
needs
there.
it needs asset allocation to start going there, and then the thing becomes a Giffen good where it just starts to get a feedback of higher prices beget higher prices, and it just starts a cycle. And the bigger question was this sufficient of a spike and a turn to begin one of these new 6 to 12-month bull cycles in commodities? And like you look. This is the first time that uranium has, for instance, traded in 4 months above its 50-day moving average. You take copper, which has been in this 4-month bear market that broke above the 50-day and broke its descending trend line, starting to turn up. Like suddenly, money's being made in this space. Iron ore stocks are ripping like it's a new bull market, and the grains have turned up. Like just everything is working, even the not so rare earths.
We got to talk about the rares. But Patrick, correct me if I'm wrong. Didn't that start with the Fed cutting?
The initial reactions off the lows were, but the last 5 days
Okay.
where
But,
all of them ripped were all China related. Like look
right.
at like copper, like the China burst was this one, right?
Right.
And so I mean, yes, everything did start to turn off, but this was sort of like you pouring gasoline on
Sure.
on the thing that got the spark going. The point here, these things are definitely all bullish, and many of these stocks have been in these often 6 to 9 month bear market declines, and some of them are so stupid cheap that now suddenly many of them have ripped to the equivalent of what the China stock market did, right? Some of these commodity stocks are up 30, 40, 50% in the span of a month. And the question, obviously, I don't like to buy rips, I buy dips, and so I'm waiting for these things to settle in a little bit. But you know, it's worth watching whether or not this was a turn in the tide. I think by the time we record the next episode a couple weeks from now, I think that a lot of dust will settle. We'll see where things kind of settle in, and we'll have a much better gauge as to whether this is going to follow through. But I want to really see that the bulls here dig in, buy dips, consolidations are held above moving averages, and that this really is showing that a new accumulation cycle has begun. If that's the case, I'm going to double down on my commodity positioning at some point.
Sounds good. All right. What else we got?
No, that's it, bud. That's all
That's
I
it.
wanted to cover. By the way, I just wanted to touch on one thing.
Okay.
It's interesting that for that U.UN, the Sprott physical, that once again we're trading at where the discount to net asset value has been closed.
Right.
Typically, you like to fade this.
I do. I think you buy minus 15s, minus 20s, and you sell evens.
Okay, but now that's just a trading strategy in itself.
Right. So,
But
like,
what's your feeling on this? Is this a fade for you in your mind?
so it depends on your time frame. So if you're sitting there and you're a long time, you know, a year from now, I think it'll be higher. A month from now, I'm not so sure.
Okay. There you go.
Right. There you go.
All right, that's all I've got. All right, so let's move on. I guess that's it for the show.
That's
isn't
it. We're gonna figure out some other segments to add in here someday.
Someday. Right now, we just have a couple of beers and a couple of guests. And
That's right.
we'll
All
shoot
right.
the shit away.
So thank you for tuning in. I don't have my script, Patrick, so I'm just gonna say, where can they find you and your wonderful content?
Well, first of all, I'm just gonna do a plug for I'm firing up my own personal YouTube channel at Patrick_Ceresna, where I've been putting a bunch of videos, and I'm trying to get some traction on it. So I'm not even gonna say anything else other than check out some of the cool videos that I put up there. I'm gonna be posting lots of stuff. I try to get some shorts out every once in a while here. Maybe Kevin, one day you might even subscribe to it yourself.
Okay, I'm gonna go.
Oh,
do
what
it
a funny
now.
joke. Well, yeah.
I never thought about that. I shall do it, and I will do it, and everyone else should do it right now as they are on their computer as well. Let me find this 1 second. So if I just search for Patrick Ceresna, there you are. Okay, there you are in this white thing. You look like you're selling like oh wait, talking now. All right, subscribe.
All right, what kind of shit are you gonna put on me?
I'm not gonna put anything. You know me. I don't read the comments.
Yeah, you're looking at an image there, and you want to say something, but
about the thing.
You're biting.
You do look like you're about to sell like some sort of yoga retreat package. Sorry. Just the upper one. The bottom one looks like the little round one. You look like you're about to tell me, come join me in Bali. We're gonna do yoga and learn how to be in one with the market. And then the below one looks quite normal.
All right. So Kev, where can they find you, buddy?
They can go check me out at the macrotourist.com. And listen, we can never have too many friends. Bull market, bear market. We're just happy to have you guys join us for this crazy ride. Now stick around for the after show.
All right, Danny, come and join us, save us here. Now, first of all, Kev, I got to say that it's Danny that's in charge of the YouTube channel, and he picked those pictures. So you know what? Like, I'm sure he's laughing his ass off. Or
he probably did it on purpose. He's like, look at what an idiot that Patrick looks like here.
I was like,
Bali. It's got that kind of vibe, like, doesn't it? Am I wrong?
It does. I think he. The thing is, we've got a bit of an old school one, and I thought, keep him relevant and cool.
Yeah.
So we'll try and keep him with the.
This
the
is what
yoga.
happens. This is what happens when you let a millennial into your life, Patrick.
No,
Yeah.
Next thing you know, he's gonna be taking pictures of his food and like sending it to you.
no, that's.
We already do that. So that's normal.
Really, Patrick? Do you
Yeah.
do that? Because we're gonna have to, kick you out of the Gen X club if you do that. No Gen X.
The problem
sends
is
pictures of
I'm
their food.
dating millennials, so
Okay.
I get dragged to their level. It's
Oh my god.
No comment. Let's just go on to the next subject. All right, let's do this beer. Let me just. I've been drinking coffee.
I'm gonna
you
go
guys.
first. I'm going first. I'm going first.
Go ahead.
Because you guys are gonna do some low score, and I'm gonna feel that I have to go high scoring it.
So you're gonna
You're
get the
already
low one in
drinking.
early.
So I'm gonna go. No, I'm going in early. Now, first of all, I love sours normally, and this one is particularly sour.
Yeah.
Like this is like literally a Jolly Rancher candy, right? Like, no, it is. I could imagine drinking this only on a really hot summer day by the pool. That's the only scenario, and I'm gonna give it a 6.2.
Oh, that's pretty good.
Like
I thought
literally,
I thought you were gonna go low,
somewhere
so
near.
we don't.
No,
Okay.
no, I'm giving it somewhere around the 2/3 mark area. Like I think that's a fair way for me to score this one.
Okay.
How about you guys?
Danny, do you want to go first? Or do you want me to do it?
For me, it was one word: indigestion. So I'm giving that a 5 out of 10.
Oh, see, Danny's.
Oh, that's an amateur score. You
I know,
got to
it's
give it
amateur,
a.
but you
I'm
know what, I kinda
trying.
like he owns it. He just goes for the evens. And he just goes, "Fuck it,
Let's
I'm
go
not even gonna
evens.
bother."
I'm not
Go
even gonna
evens.
bother. That's literally I'm not voting.
Yeah.
Like literally giving a 5 out of 10 is I'm just gonna stay out of this. You guys figure this out.
Yeah, that's like a Canadian thing to do. That's very mopey. Okay, as you know, I hate sours, so I don't think I've ever given a sour more than 5. I'm not starting today. But if Patrick is correct, I've given lots of 3 5s and things like that. This is a damn good sour, but it's still
Damn
a sour.
good.
Damn good sour. I actually really like it. You say it looks. Oh shit! Stuff's falling from my office here. So it's damn good sour. I'm gonna give it a 4.8, which is a good rating for me.
Oh my
Okay.
god, a 4.8. See now, Danny, at least he did a more pro score and gave it the decimal. It's like giving it a 5.
Oh, no.
You could have at least said a 5.00. Like you could have just made it incredibly
Like precision.
like
Okay, so you guys had some sort of Trading Masters event in Lisbon that you wanted to regale
Well,
us
no,
the
it
stories of.
was awesome. Danny was there. He was coordinating a lot of the stuff. It was awesome. Just wanted to do a shout out to all of those. Like we had 25 of our inner circle members come out there, flew in to trade a week long with me. It was pretty awesome. There's some pictures there Danny's sharing, but yeah, it was a great time. It was such a pleasure meeting all of them, and actually, it was many of them I've actually met on numerous occasions. Some great members, but just wanted to give them all a great shout out. It was a pleasure spending the week with all of you.
I want to give a big hats off to you, Patrick. Usually, always when you look at male-female ratios for anything to do with finance, it's like 95% dudes, and it looks like it's almost even up.
Yeah, they brought their spouses. but
Okay, I'm sorry. I was trying.
Oh, there you go.
There's
That's the money.
Patrick. What are
That's
you
the money.
tasting there?
We went to a Portuguese winery for lunch, and we got a great wine tasting. It was awesome. It's a good Portuguese wine. I forgot the name of it though.
That's nice. Well
It's
done.
right there. If we look here, you can actually see the name. This guy.
Oh, there you go.
Yeah.
Ah,
It was pretty good.
I still can't pronounce Portuguese, so whatever that said on the back, you can.
did you guys go to Sintra? Where did you guys? What
Yeah,
beaches
yeah.
at?
We went on a massive jeep tour of Sintra and everything. It was pretty awesome.
Oh, there you go, Sintra. I got to say it like that.
Yeah, this is the
As
Jeep
Anglophile,
talk.
Saint Sintra.
yeah.
So I know that the Portuguese are getting a little upset about all the tourists. Did they must be
No,
especially.
that's no.
No? They love
No,
you.
that's
Wait till
no,
Lotus
they,
sees us. He loves us.
You're no, but it's the Spanish that are getting all wound up about tourists, particularly in Barcelona. but the Portuguese are pretty chill right now. They're
Lovely people. That's
lovely people.
Yes, of course.
It's
All right.
a good time.
Okay,
Anyway,
well, we should get going 'cause
what's
I gotta
new
go
with you,
trade the
Kev?
rest of the day.
Oh, yeah, okay,
Nothing much. I was away for a couple of weeks, so
That's what I was about to say.
yeah,
Have a
we
good
were
time?
away, but I was away, but it was can't talk about it.
Okay.
Macro Fight Club. First rule of Macro Fight Club. You don't like
We'll talk.
All right.
All right. Okay. Listen, have
everyone-
a good trading day, bud.
Yeah, take
hello,
care.
everyone. Or, goodbye,
Bye-bye.
everyone.